Good morning. Welcome to the Monday Market Update. As always, we're back from break. I'm Nash Paradise. Alongside here with me is Andrew Cady. Mr. Cady, how is the weather down there in beautiful sunny Florida?
Oh, it's 70 degrees and sunny.
70 and sunny is not bad. I think we hit 92 in North Texas yesterday, which was a little warm. Spring is gone, and now we're hot. So, 3 seasons in a day. It's a good time. Speaking of 3 seasons in a day, this Texas weather feels a lot like what's been going on in our markets here. As I was out for spring break, just doing my thing, and then I get some updates, some alerts, some text messages that everything has gone wild. And I feel like this chart doesn't necessarily paint the picture or tell the story. Can you walk us through a little bit what we're looking at here?
Yeah, the markets were not happy on Friday. I think we had the single biggest movement day in mortgage-backed securities, ironically, in 6 years, dating back to March 2020, when everything went bad really, really quickly and then got really, really good a month later. But yeah, rates decided to tick their way up. We actually had kind of a little bit of a settling down towards the end of the day on the 17th into the 18th, and then Thursday, Friday just tanked. And this was all on data from all. We'll dive into it, but yeah, it was not a pretty week for mortgage rates.
I got you. So it looks like that line is pretty flat, but yeah, I saw those headlines too. I saw the, minus 80, minus 90 basis points on the UMBS security. So was there hedging going on before that, or have we just not caught up to where those increases were? Is the spread narrowing? Why is it not as bad as it looks?
The spread is not narrowing. I definitely think there was a lot of hedging that was put into place ahead of time. It sure feels like it. We saw just a little bit of settling down of rates, 6.4 to about 6.3. And I just don't think there was much given back. And so, that drop should have been lower and the rise should have been higher. But a lot of this data just came on Friday with, the European Central Bank at the Bank of England talking about hiking interest rates. And it really spooked the markets. Having a rebound today, but not as much as we lost.
Got it. Well, let's talk about what happened last week here, and you can, bring me up to speed on the data. So you said late last week. Now, I know we don't have any data points from late last week, but everything happened late last week. So, it feels weird not to talk about a Fed week with the, FOMC meeting, but that seems like it was kind of a non-issue last week, right?
It kind of was. Powell did not help the markets at his press conference at all. As expected. I talked about it on the last week's update. I said there's really all news is going to be on Fed Powell's speech, and the markets definitely turned sour immediately. Well, during his speech, but I also kind of threw out yesterday. I was like, the producer price index probably not going to be a big issue. Obviously, I think I said, obviously, if it comes in at like 4.5%, it's probably going to be an issue. And lo and behold, the producer price index came in at 0.43%. So massive, massive miss on PPI. And I don't think that moved markets as much. But I think the combination of that and then Powell in his speech really started the spooking of the markets, followed by Friday morning really just getting hammered by ECB and Bank of England.
Okay, so talk to me about Friday a little bit because I saw the headlines. I was flying back at that time, and I saw banks are the ones moving the needle, but it's really oil, and banks are blaming oil, but it's really oil, and it's really just oil. So how accurate is that, and what really went on Friday?
Markets are volatile based on predictive movements. And ironically, oil isn't up that much last week. Yeah, it moved up, but it wasn't like what we've seen. I mean, we've seen these 30-40% rises in oil. It was a moderate rise in oil, but I think it was enough of a rise and a continued rise that the European Central Bank and the Bank of England kind of put everyone on notice saying, hey, we're prepared to raise interest rates, not hold steady any longer. And obviously, the world's markets are very, very interconnected. And I was on vacation last week as well. I was out with family and I was reading news as I was walking the streets of New York City. And I'm like, it's going to be a very adventurous Friday. And it definitely proved to be an adventurous Friday because anytime any central bank talks about raising interest rates, that spreads shockwaves through the world.
Yeah, the trickle down effect is not a whole lot of fun there. But let's talk about what we got going on this week now. Looking at the calendar here, I see, Tuesday looks like a pretty busy day. We got some good stuff coming in. As we get to the end of the week, you got the jobless and continued claims on Thursday. It's not the big jobs report, so nothing too crazy. Anything that steps out for you as far as things to watch?
I don't really see anything on here being a big mover. I think we're going to rely very heavily on very heavily this week on a whole bunch of nothing burgers for data. This is going to be very oil and war driven week, unfortunately.
Yeah.
We're seeing a rebound this morning of 30 basis points right now. 10-year treasury in pre-market trading was up to almost 4.45. We're 5 basis points lower or 4 basis points lower than we closed on Friday. And that's with Trump's talking about pausing the war while they go to talks. Now, it sounds like Tehran has come out and said, we have no idea what talks you're talking about. So this might be a short-lived betterment, but this is going to be a week based on not really the data we have on our screen. Yeah, the global manufacturing PMI could swing things a little bit, but I don't see that being as important as what's going on with the conflict in Iran and what's going on with oil. That's going to be the big ticker for the time being going forward.
Yeah, you hit on what I wanted to hit on here, and this is the big risk about this week is what happened this morning. A lot of people, a lot of industry professionals, mortgage guys open their ticker and see green and think, oh, good, finally got some bounce back. You didn't see what happened at 5:30 a.m., at 6 a.m. That 10-year treasury yield up to 4.443. It looked like it was going to be a bloodbath today. Capping off what happened Friday into pre-market on Monday, it's bad. And like Andrew said, it is the supposed talks about a potential ceasefire to try to open up the Strait of Hormuz and have some conversation around de-escalating the current conflict in Iran, which may or may not actually be happening. The news is not real conclusive on that. So now we're a whole lot better because of this implied improvement in that discussion. Before we had that, we were a whole lot worse. What does that mean? If this isn't legitimate, if you get a tweet and it seems like tensions are escalating and not de-escalating, we could see an almost instant reversal. This is going to be a very dicey, week until we get some more concrete evidence of what's going on. This is definitely one of those red alerts. If it's good, lock it. It just doesn't make sense to roll the dice right now because by all, accounts, we don't know what's going on. And when we find out what's going on, there's a 50-50 shot that things go back to where they were pre-market, and that's really bad for us.
Yeah, and I'll say this. One thing we have seen with this administration over the last 90, 120 days is a lot of talk and not a lot of action. We've heard a lot of things that aren't I don't know if I want to say factual, but they're not happening. Like we heard, what was this, just 30 days ago, that we now control Venezuela's oil, the second largest oil supply in the world. Yet we're not touching that oil. So like there's a lot of things that are being said that might not simply be fact. So rolling the dice with your client's interest rate lock would be a very risky play, in my opinion, this week. I believe we will probably see the 10-year treasury hit the 4.49 before we actually see a meaningful rebound. I hope we don't break above that. That's kind of our next ceiling, is a 4.49. I do believe we'll see it. I think we're going to hit it. I hope it bounces off of that and starts to come down. But we're in a huge wide range, guys. We're in a range from 4.33 to 4.49 on the 10-year treasury. Just because it's green today does not mean go. Do not pass go. Do not collect $200. This is not a free ride. Markets are not happy right now, and we need to be very cautious.
Yeah, this is what we call a tailspin. It can just keep unraveling. Like, forget resistance points. Like, you may get a little bounce back, but until we feel confident in the bond market that there's going to be some consistency going forward, and we can see the end of this conflict, yeah, it could go from bad to worse, and then it could get more worse, and it could redefine worse. I've even seen a bunch of articles talking about, could interest rates get back up over 7% again? In a prolonged conflict, it absolutely could. The good news is we've seen what the market can do before this. So there is that range of bounce back, whenever whatever is concluded and we get back to some, global normalcy, whatever that is, we should see markets, they'll come back down slower than it went up, but we should see, all the economic indicators now making sense again. The stagflation in the labor market, inflation will take a little while to get back down after things are impacted by the higher oil prices. If we get there for a while, all that to say, yeah, I mean, later this year, who knows? There is no good leading indicator of where we're going. Just that once we're done, we should get back to this hold market that we've had in the low sixes. I think that's a good long-term projection, but until we get there, and take what you got, it could get a whole lot worse.
Yeah, and I think, if you want to put a date on your calendar, all my eyes personally are on April 10th as the date that is going to be kind of a make or break date, in my opinion, because April 10th is the date that March's inflation report gets released. Mm-hmm. We know March's inflation report is going to be ugly because of the conflict with Iran. And my personal gut says if there is not a meaningful end in sight or an end happening to the conflict in Iran on April 10th, we could see things get significantly worse very, very quickly, because I believe investors will look at that March report rather than as a blip in the radar, a one-off because of the conflict. Investors will look at that as the first report of a cycle of higher inflation, of a cycle of this. And so for me, April 10th is the big day. I think this conflict needs to be wrapped up meaningfully by that time, or we could see things get substantially worse. And if they get worse, the Fed's in a bad spot, because the Fed just can't cut interest rates because we have higher inflation. So they would almost have to go back to a quantitative easing stance to try and calm markets if we really start to see things sell off.
Yeah, let's talk about the Fed and, our futures here, what we're looking at as far as movement and momentum. This looks a lot different than the last time I saw it 2 weeks ago. This is just a straight line block. That's very high certainty that we're not getting better. There are 0% all the way through second quarter of 2027. There's a few on here now that are showing a higher, probability of an increase. Now, I will say I'm in this in real time. I refreshed it like 20 minutes ago. It has cooled off slightly. We are not so high on the 375 to 400, which would be an increase in the Fed funds rate. So I do think we're settling down a little bit, but just that shows how fast these are reacting throughout the same day. But what it is getting at is the chances and likelihood of this 1 to 2 rate drops that we thought we were going to have, that projection of 300 to 325 by the end of the year, it's not happening.
Yeah, at least investors don't believe it's happening, and I'm concerned about the market. I think a quantitative easing stance will be the only move the Fed has, which is not good for future, because that creates more debt and it creates more problems. So it's buckle up, buckle your seatbelts. It's going to be a very interesting next few months.
100%. All right, let's see where we got moving forward. I don't even want to see the next chart. Ooh, okay. We got so comfortable in that sub 6.25 range. And honestly, what I hate to point out here is that 6.5 isn't really a 6.5. Yeah, sometimes when we get these average overnight rates, you'll see, yeah, that lines up. Like the rate sheets are, there, everything makes sense. And what you've got going on right now is you've got a lot of people not locking, or you have a lot of people taking huge pricing hits and concessions, big banks that are trimming up margins to try to keep people on board because of the massive increase in short amount of time.
Correct.
So you've got things being locked under normal, smaller spreads, under different yields. There's always going to be a bit of a catch up there when you have an extreme increase like this. Because I know if you're watching this, you're like, oh, can I get a 6.53 anywhere close? No, not conventional. Like, actual interest rates are a good bit higher than this for things that are going in. So we'll see this continue to increase, I think, or costs just continue to keep going up as people lean into, well, I can sell mid sixes, but I don't really want to go under the 6.99. What are you seeing on your end?
Yeah, and keep in mind that I just said this. It's so funny you bring this up because I said this on last week as well. Like, keep in mind the 6.5. Yes, what you said is very accurate. Lenders are locking under par right now because they were floating interest rates and they're trying to not lose their pipeline. But you also have to understand this is the perfect client. This is an 800 credit score, 25, 30% down, primary residence purchase. The majority of homeowners with a 716 FICO putting 5% down, you're seeing more like 6.75 on your rate sheet, not a 6.5. Like understand that this is the ideal, perfect, unique client scenario that rarely happens.
Yeah. And along those same lines too, where this isn't relevant to all clients, it is relevant to the news cycle. Yeah. News cycle likes to talk about things going poorly, especially when they can blame our current administration. It's just a fact. It's been like that for my entire adult life. If things are going bad, if there's bad news gets clicks, bad news gets views, gets people to engage and talk about it. And if you can cast, an administration in a negative light, they're going to do that. That's exactly what we're seeing. I've got a couple of headlines in front of me. Interest rates soar over 6.5%. Home buyers, pull out of the marketplace, listings left to linger. As this is significant for news, even though it's actually worse than this, it's still, going over 6.5% makes headlines. We haven't been here since late 2025?
September.
Yeah. But I mean, at the end of the day, going from 6.25 to 6.5 isn't that significant, but it's everything else that happens because of that. It becomes more difficult to find the winners in this market and to be able to see where, maybe there are some buyers pumping the brakes. Maybe there are people hanging out, maybe sellers do get a little more flexible because they're worried about the market changing with, the way things are going at interest rates, where you can get an extra $5,000, $10,000, $15,000 in concessions or off the price. You have to have a discerning eye to figure out where the wins are going to be in this market. Because, if you just look at this and share, oh yeah, rates are heading up, rates are going up, you're walking that same narrative line that's not necessarily going to bring the right people in that you can help, or you can find the wins in this market.
100%. Could not agree more. Well said. I can't add to that.
Well, I love tying a nice bow on it. So this week, we don't know. This week is all about news cycles, head on a swivel, being ready, getting people to take action. I feel like today's going to be a good day to lock stuff in and to get in front of that. You got all the bits and pieces that you need to be able to say, hey, look, this was so much worse early this morning and it's fake good right now. So take your fake good and run with it. Any other takeaways you'd give to professionals in the marketplace right now?
Don't gamble with your client's money unless your client is specifically telling you to gamble with their money. I see it. I see it all over. Loan originators, you are not as smart. If you were so smart that you know where mortgage rates are going, why don't you just trade bonds all day and make $1 million? So many loan originators let their clients think the loan is locked while floating the loan to try and gain a little bit back. And you're gambling with your client's money, and don't do it.
Yeah, I've seen you ripping people on the internet on that. I was like, oh yeah, there goes Andrew. There's something to be said for having integrity in this world. It's not worth the risk.
It's not.
If you can't have that conversation of here's why rates are what they are, then hopefully you're watching this, because if you're on this, you've got your talking points. You know how to have that conversation. But again, you know how to structure and position this that they could get a whole lot worse. So, we're going to take the little L to prevent the big L, do the right thing by your clients, find the winners in this market, and then check back in with us next Monday. We'll help get you prepared for another week and another Monday market update.
All right. Take care, everybody.
Have a good one.